Hello, this is Mark from TradeInform.com and welcome to this video on analysing a Fibonacci retracement trading strategy. So what I want to do in this video is get some hard data, some actual verifiable backtest results on the effectiveness or not of a simple Fibonacci retracement trading strategy. Now, the trading strategy that I'm going to look at is going to be a simple trend following strategy. We're going to look at long trades when the market is above the 200 moving average and short trades when the market is below. That is the only other criteria apart from the Fibonacci levels. Firstly, I want to talk a little bit about what I mean by a Fibonacci retracement. So here we have the market mostly above this level, and so we are looking for long trades. And the first thing we need before we can have our Fibonacci levels is to identify significant lows and significant highs. Now I've got one here at the bottom of the chart. We've got a significant low and a significant high. Whenever we're in an uptrend and we want to identify Fibonacci retracements, we always go from a low to the high. And what I mean by a significant low or high is anything that's got a lot of blank space behind to the left. Here again, we have a significant high because there's a lot of blank space to the left. So we've established our significant low, a significant high. We can now look at the Fibonacci levels. We have 23.6%, which is usually the first and the least significant Fibonacci level. Then we have 38.2%, 50%, which is not a true Fibonacci number, but it is usually considered, and I'll be using it as the same in this analysis. And then 61.8%. So back here to our price action, we can see that 23.6% did not deliver a lot of support. 38.2%, we get a bit more support, but price again went below. And before we got what we wanted, which occurred here, in this case, at the 50% level, price found a good level of support and eventually strengthened and resumed the initial trend. Now if we do that again, we can have another look at the next. We have a fairly significant low here. Again, it's an uptrend, so we go from low to high, and we have definitely a significant high. There's a lot of blank space. And we can see here in this example, the market was strong and did not retrace very much at all. The 23.6% level appears to have attracted the price, but not anything below that. 38.2 and anything below was not touched. So there we go, we have Fibonacci retracements in a long trend. If I scroll the market on a little bit, we have a very significant high here. Now, in this case, we're looking at trends to movements to the downside. So we're going to be mostly below this. And I'm going to start off the analysis looking at this high. We're in a downtrend. We start from the high point. And we've got a very significant low here as well, with lots of blank space to the left. Now we can see that after this quite big move here, we have a period of consolidation. Initial strong candle, and then the price meanders up and down. Finally, we hit this 38.2% level, and we have the resistance that we wanted, and the price then proceeds to the downside. Now, in this case, this entry point would have been above the 200 moving average, and so it wouldn't have been included in the strategy that I'm testing today, but it is still, in retrospect, a very nice trading entry. And in fact, it is the best Fibonacci entry we get for some time. Any Forex traders may well remember this very significant move to the downside that we got with the euro US dollar throughout the end of 2014 and into 2015, where the price just went down and down with very little retracement. Okay, so it's nice looking at Fibonacci's on charts, but I'm sure everybody has seen them before. How are we going to analyze it? Well, this is a trade-informed backtest spreadsheet, and there is a link on the screen if you'd like more information about these. There is a variety of them on the tradeinformed.com website. They allow the trader and backtester to test any historic data, a huge variety of different entry systems, from chart patterns to technical indicators. Anything that can be reduced to numbers you can test using a trade-informed backtest model. And also it allows to go long and short with a profit target, stop loss, trailing stop. So what have I done in this particular model? Well, I've set up a check here looking at our recent highs and our recent lows. As I said, these are significant highs and lows, and I've quantified them as significant if they are a new 21 period high or low. Now 21 is a fairly arbitrary number. It could be any number, of course. The higher the number, the more significant the level, generally speaking. 21 is, of course, it's one of the Fibonacci sequence, and I wanted to try and include relatively high number of trades, so this is why I've chosen 21. Okay, so these are the results. Now I've started off looking at the first Fibonacci level, which is 23.6. You can see here we've got a relatively low win percentage, but then overall, over this period of time, which is a significant period of time, 1989, end of 1989 to beginning of 2015, it is a significant period of time, but the trading strategy has performed pretty steadily, with a bit of a meander here in the early days before strengthening. Okay, so that's 23.6%. 38.2%. You can see here that we do have a higher net profit, and also profit factor, which measures the ratio between the winning trades and losing trades, is higher, which means we're getting a more significant number of winning trades than we are losing trades. You see we get a fairly similar capital graph over this time period. Okay, 50%. Net profit is lower, and we're getting a choppier capital. Part of this can obviously be explained by the fact that 50% retracement is hit much less than 38.2%. So we have fewer trades to base our analysis on. Final level I'm going to test today is the 61.8% level. Now, using these profit targets and stop losses, we can see that we're getting a much lower net profit and profit factor. In fact, over this time we have a negative expectation. However, we should never forget the significance of using profit targets and stop losses, which can, in any trading strategy, can be the difference between profitable and unprofitable, and should be looked and checked very carefully. If I was to change, for example, the profit targets to a ratio of 10 to 5, we can see we have a better net profit. Still relatively low, but we have a better level of net profit. Okay, so on the basis of the analysis that I'm going to include in this video, we can say that For the euro US dollar, historically speaking, based on a strategy trading in the direction of the dominant trend, the 38.2% level has historically the best level of profit and profit factor. If you'd like to get more information about my results, there is an article on Trade Informed about this video, so please click on the link to get more information. And as I said previously, this spreadsheet is also available for sale on the Trade Informed website, and there is another link on the screen for more information about this. Okay, I hope you enjoyed this video. If you would like more information about trading strategies, about the financial markets in general, please subscribe and go to www.tradeinformed.com.